Hello, everyone. This is Samantha from the law offices of Samantha Wolfe, and I'm joining you this afternoon for this month's virtual seminar. And today we're talking about gifting and charitable contributions. So I'm going to go ahead and share my screen so that we can start our presentation. Thank you all for joining us. I really appreciate it. So today's title is called Hacks for Generous Hearts, How to Give and Save Big. Man, I really messed that up. Let me try again. Tax Hacks for Generous Hearts, How to Give and Save Big. I will tell you, my intern created all of the titles, and so I discovered that sometimes I have trouble reciting them. So the reason that we do our virtual seminars is we do feel like it's part of our mission to get out information to our clients and referral sources. So we're happy that you all could join us. Okay, let's start with generally talking about why charitable giving matters. We have so many clients that have very generous hearts and have a lot of questions about charitable giving. So these are some of the key reasons that they tell us that they want to give. So they want to support causes and organizations that you may care about. They want to leave a legacy of philanthropy for future generations. They want to strengthen communities, fund research, and create social change. And also, they may feel good about giving while also reducing some taxes. So there are different types of charitable contributions that you can make, and a lot of this is going to depend on, based on the type of contribution or donation you make, may dictate how much you can deduct for income tax purposes. So the first type of donations, and the most common one, would be cash donations. These are simple, immediate, and the deduction limits are based on adjusted gross income. So typically, you can deduct as long as it's less than or up to 60% of your adjusted gross income if it's a cash donation. Donations of appreciated assets, this would be stock, real estate, and other assets that may have some sort of value or significant gains. We see some clients that are trying to pass those gains or shift them out of their estate tax burden. And so sometimes we have clients that do that. They do receive a deduction for the fair market value, and in most cases, they're able to avoid capital gains. Now, whenever we're doing donations of appreciated assets, that's where we may start to see lower percentages, and that just may mean that usually it's anywhere from 20 to 50% of your adjusted gross income that you can deduct for donation of appreciated assets, depending on the type of donation, whether it's to a public charity or a private foundation. That will then limit how much you can deduct for income tax purposes. And then our last category of types of contribution would be tangible personal property. So things like art collections, antiques, or other collectibles. If they're made to qualifying charities, you can get a charitable deduction for those. Interestingly, every spring and fall when the weather changes, I try to go through my closet and kind of sift through and figure out what clothes I'm going to donate to different charities. And when I donated the last time, they actually asked me if I wanted a receipt for charitable contribution. So that would have been a personal property contribution because it would have been clothing. So the tax benefits from charitable giving, you get immediate tax savings. So federal income tax deductions for contributions to qualifying organizations up to that 60% of adjusted gross income for cash donations. It does give you some estate tax benefits. So if you think about it like this, obviously income taxes, if you make a charitable donation, you get a benefit. But there's also a benefit if at your death, you have a certain amount of your estate or certain funds that you want to earmark for charities. The benefit there is it reduces your taxable estate, and it doesn't have any Pennsylvania inheritance tax either, because charitable gifts are exempt from Pennsylvania inheritance tax. I did have a client that I met with earlier in the month who she decided to structure her estate where, to the extent that there would be any type of federal estate tax, because she was worried with a possible sunset at the end of 2025 with the federal estate dropping to 5 million, maybe 7 million. She was concerned that she might have a federal estate tax concern. So what we did for her is we just altered her estate plan to say, to the extent that her estate exceeds whatever the exemption is when she dies, that amount that is in excess of the exemption would go to certain charities that she selected. And then that way, she doesn't have to come back and change her estate plan based on what the federal exemption does at the end of 2025. So we tried to be a little flexible with her estate plan. It also avoids capital gains tax. So we talked about this, where if you would donate appreciated assets instead of selling them yourself, if you would donate them to charities or into a charitable trust, normally you can then avoid having to recognize the capital gain on those assets. Now, types of charitable strategies, we're going to go through each of these. So we have donor advised funds, charitable remainder trust, charitable lead trust, qualified charitable donations or distributions, and then charitable gift annuities. And some of these are based on how easy they are to do and whether or not you actually need a legal document to do them. So the first is a donor advised fund. So the benefit here is that our office typically doesn't have to draft anything for a donor advised fund. More and more financial institutions are allowing donor advised funds. So a donor advised fund is just a giving account that would be established through a public charity or a financial institution. So, Edward Jones, Raymond James, Merrill Lynch, Morgan Stanley, those type of financial institutions, they do have the ability to have donor advised funds now. And what that means is that the donor, the taxpayer, can contribute assets to the account. They can take immediate tax deduction for income tax purposes. And then what that does is it allows them to put the funds into an account. And most of the time they just have to promise it to charity, but they don't actually have to select the charities right now. So sometimes we have clients that say, hey, we know we want our estate to benefit charity, and we may even know we want a certain percentage to benefit charity, but we haven't exactly identified those charities. And the benefit of a donor advised fund is you don't have to specifically have the charities identified, but you do have to know that this money is going to go to charities that you would select or that your beneficiaries would select. Now, the benefit here would be that you get an immediate tax deduction. So contributions are deductible in the year that you make the transfer into the donor advised fund. It's very flexible. Funds can grow tax-free, and then they're distributed to charities at a later date. And it's very simple. So it's a single account that can support multiple charities. You don't need a legal document to do it. And so it's really low cost. You don't have a lot of administrative expenses that you have to worry about with a donor advised fund. So this strategy would be ideal for those individuals that would be looking for a tax efficient way to manage charitable giving while maintaining flexibility. So if you're thinking whether it be a certain percentage of your estate or whether you're thinking you just want to make every year some charitable contributions, you could use a donor advised fund. The next category would be the type of trust that we can use. Now, just know that a charitable remainder trust and a charitable lead trust, these are going to be documents that you will have to work not only with your financial advisor, but also with a legal professional or with an attorney. With a donor advised fund, again, normally you might have an attorney that's involved in your estate planning, and usually you're running scenarios by them for the donor advised fund, but you don't actually have to have the attorney draft anything for a donor advised fund. So that's why we kind of started there. It's real simple as far as the administrative costs. Charitable remainder trust and charitable lead trust, there's usually a legal expense to set these up because we actually have to draft the trust document. And these trusts are really just a set of rules that say how do any assets that you transfer into the trust, how are they administered? And so a charitable remainder trust would be a trust that provides income to the donor, or it could be other beneficiaries. So sometimes we have parents that set it up where the beneficiaries of the trust would be children or grandchildren for their lifetime. But usually we see it where the grantor is setting it up and they're reserving income for their life or a set term of years. Like they may say for 10 years, I want to receive a certain amount off the assets in the trust. And then after that, the remainder would go to a designated charity. And so charitable remainder trusts are where you or your beneficiaries are starting off with a benefit, and then at the end of the term of years or at the death of the beneficiary, it goes to charity. Now, the benefits of this would be there's an immediate tax deduction for this, and that's based on the present value of the remainder going to charity. I have a really neat program that allows me to calculate this, but one of the things we have to do is we have to make sure that the value that we're putting into the trust isn't going to fail going to the charity. And so there's a certain calculation we have to run. And when I run it, my computer program is going to say, yes, this meets the requirements for a charitable remainder trust under the IRS section, because there's a certain 10% rule, meaning that has to have a likelihood of less than 10% that it would fail going to charity, or that you would exhaust all of the funds paying out to the beneficiaries and nothing would go to charity. So you always want to work with an attorney to help you do this, but you do get that immediate tax deduction. It does allow an income stream. So this is a situation different from a donor advised fund, because a donor advised fund, you're setting aside the funds and then you yourself aren't using these funds. With a charitable remainder trust, you're putting funds into the trust, but a certain income amount is coming back to you every year. And in a charitable remainder trust, there are capital gains that are deferred. So again, you can sell appreciated assets inside the trust, and that would avoid the capital gains that you would have if you sold them as an individual. So sometimes you might use charitable remainder trust in conjunction with a transfer of appreciated assets. So an example of a charitable remainder trust would be the donor transfers appreciated stock into a charitable remainder trust, sells it tax-free, and then uses the proceeds to provide lifetime income to the grantor while leaving the remainder to charity. So it can work really great in the situation where we have appreciated assets. There's a second type of charitable trust, and that's a charitable lead trust. So the remainder means that it goes to individuals first, and then upon their death or at the end of the term of years, then it goes to charity. The lead trust flips it. It actually goes to charity first, and then at the end of the term of years, then it would pay to certain individuals. So this is a trust that provides income to a charity for a set period of years, and then after that term of years, the remaining assets would go to, usually in this case, it would be the donor's heirs or other beneficiaries that they name. And it doesn't have to be heirs or other beneficiaries, but that's usually how we see it. So most of the time with a remainder trust, the first type of trust we looked at, the grantors retaining a certain amount of income for their lifetime. Then it goes to charity. For a lead trust, it goes to charity for a set period of time, and then at the end of that set period of time, normally it's going to go to beneficiaries that you would select. The benefits would be it reduces the taxable estate, so transferring assets to heirs with minimal gift or estate tax. So that's the beauty of the lead trust. It does give a tax deduction, so donors may receive an immediate deduction for the value of the income portion that's going to pay to the charity. And the flexibility here is it can be structured as a grantor or a non-grantor trust depending on the tax goals. So there's a lot of different things you can do with lead trusts. I would say that most of the time when clients are looking at trusts, though, they tend to favor the remainder trust because they want to keep a certain amount for themselves. But we're seeing more and more lead trusts just because we might have families that want to provide for charities and then have it go to certain beneficiaries, and they might be charitably inclined. A lead trust is going to be ideal for high net worth individuals that are seeking to support charities currently while preserving wealth for their heirs in the future. Charitably minded individuals seeking to minimize tax exposure on large estates. Then I have this diagram that just starts with the donor, and the donor contributes cash or other assets to fund the trust. Then the trust makes payments to the charity on a fixed schedule for the term of the trust. And then the remaining assets in the trust after that term either pay back to the donor or pay to the designated beneficiary or beneficiaries when that trust term expires. So that would be a way that you could set this up. Now, the tip here in the corner is just saying a charity with a donor advised fund program can receive the payments from a charitable lead trust. So again, you can use several of these strategies together if you would want to do that. Let's talk about qualified charitable distributions. So the beauty of a QCD is that, again, you don't need an attorney to do this. There's nothing that an attorney has to draft in order for you to take advantage of a qualified charitable distribution. So a qualified charitable distribution is a direct transfer from your IRA, your individual retirement account, to a qualifying charity for individuals that are at least 70 and a half or older. And the key benefits here, the reason that a lot of people use these is because usually, now remember, they increase the required beginning date for RMDs to 73. It's 73 currently. But if you've started taking RMDs, or if you're age 70 and a half, what you can do is you can take your RMD that you would have to start taking and you can allocate it directly to the charity. So it goes from your IRA plan administrator directly to the charity of your choice. And that would satisfy your RMD. The reason why it gives you a benefit is because you never have to include it in your adjusted gross income. So normally when you take an RMD, you have to include it in your adjusted gross income and pay tax on it. But here, if you're already charitably minded and you want to allocate a portion or all of your RMD to a charity, the amount that you apportion to the charity doesn't have to be included in your adjusted gross income. So it allows you to benefit charities, take your RMD without increasing your taxable income. Now, the distribution is excluded from your gross income, so that's how it gives a tax benefit to you. Now, the limit here is up to $100,000 per individual annually. This is adjusted for inflation, so in 2025, this amount is $108,000 per individual annually. So again, if you have to take an RMD, you can contribute up to $108,000 of that RMD and allocate it directly to the charity so that you don't have to include it in your adjusted gross income. This would be ideal for retirees who want to reduce their taxable income while supporting charities. And the beauty of this, like I said, is that you do not need an attorney to draft anything at all. This is something that you can do every year, and you can decide year to year how much or if you want to do this. So an example of this would be a retiree age 75 would use this QCD to transfer $20,000 from their IRA to their favorite charity, satisfying a portion of their RMD and avoiding taxes on that distribution, meaning they didn't have to include that $20,000 in their adjusted gross income, which they normally would have to do. Let's move to charitable gift annuities. So this is another one where, depending on how you set it up, you don't necessarily need an attorney. And the way this works is that the donor or the taxpayer gives a lump sum. It could be cash, securities, or other assets to the charity. Part of the donation is considered a charitable gift, and the rest funds the annuity payments. So again, this is a contract typically between the donor or the taxpayer and the financial institution, or sometimes even the charity can have charitable gift annuity contracts that you can utilize for this purpose. Now, the income payments, the charity pays the donor or other annuitants that are selected a guaranteed fixed income for life, and payment rates are often determined by the American Council on Gift Annuities and are based on the donor's age. Older donors typically receive higher payment rates. So if you think about it like this is very similar to a charitable remainder trust, where you're putting money in, you're receiving a certain amount every year, and then a certain amount goes to charity. So this is a less expensive and more cost-efficient way to do that. So that's why I like this option for clients. You don't have as much administrative costs. The charitable deduction in this case would be the donor is eligible for an immediate income tax deduction based on the estimated value of the charitable gift portion. A portion of the annuity payments may also be tax-free for a period depending on the donor's life expectancy. So the end result of this charitable strategy would be upon the donor's death or at the end of the term, the remaining funds are retained by the charity to support its mission. And we're seeing more and more charities have charitable gift annuity options, and more financial institutions doing these. So this is just a diagram showing you how a charitable gift annuity works. So we start with the donor. The donor signs an annuity agreement with the charity, makes a lump sum donation, and takes a partial tax deduction. And then the charity, following number 2, the donation is invested by the charity, and then 3, the donor receives payments on a fixed schedule for life per the terms of the annuity agreement. And then number 4 is just saying that the charity receives the balance of the invested funds upon the donor's death. And again, more and more we're seeing charities have these charitable gift annuities as an option for clients to be able to use. So if you're charitably minded, it might be a good question to ask the charity is, do they have charitable gift annuity agreements that you could enter into if this is something that would accomplish what you wanted? Now, I also wanted to talk today about public charities versus private foundations because this is something I don't think we've done a good job of explaining previously. So, a lot of times clients will talk about making donations to 501c3s, and a 501c3 can either be a public charity or it can be a private foundation. So I wanted to explain the difference between them. So a public charity would be a nonprofit organization that receives funding from a broad base of donors. So this would be individuals in the community contribute, corporations might contribute, government entities might contribute to this charity. So the examples of a public charity would be hospitals, churches, universities, and organizations like the Red Cross or the American Cancer Society. Those would all be public charities. The key characteristics is that the charity must derive significant financial support from the public. So through donations, through grants, all of that. And it's subject to less restrictive regulations than private foundations. Because private foundations, and we're going to look at this next, because they typically get most of their donations from a smaller group of people, maybe related parties, for example, there are more restrictions on the amount that you can deduct. So that's where we start to see, remember we started with cash donations, you could deduct up to 60% of your adjusted gross income. But like I said, it starts at 20% and goes up from there. So sometimes this is dependent on the type of contribution, whether it's a cash, appreciated property, or personal property. But the other way that we see certain percentages being lowered, meaning the amount you can deduct, is if it's a private foundation, we see that there are typically more restrictions on what you can deduct. Now, another key characteristic would be a public charity directly engages charitable activities such as providing services, grants, or research to the general public, meaning it's not targeted to a specific subset of individuals. So examples of this would be local community foundations, any public schools, and any nonprofit health organizations. So if 2/3 of their support comes from the public at large, we can't identify certain families or certain individuals, then it would be considered a public charity. Benefit of a public charity is it usually allows you to deduct a higher percentage of the contribution that you're making. Now, a private foundation is still a nonprofit organization. It's typically funded by a single individual, family, or corporation. It exists primarily to manage and distribute charitable funds rather than directly perform the charitable activities. So, for example, a lot of private foundations will make distributions out to other charities or individuals rather than actually have some sort of event or charitable activity. Key characteristics is it's typically funded by one or a few sources, meaning that if you don't get your support, 2/3 of your support from the public at large, you're typically by default a private foundation. You must meet minimum annual distribution requirements, and that usually means that you have to distribute 5% of the assets of the private foundation annually. It's subject to stricter IRS rules regarding investments, self-dealing, and any grants. And it can either be a private foundation that's set up as a corporation, or it can be a private foundation that's set up as a trust. You can do it either of those ways. A good example would be the Bill and Melinda Gates Foundation. That would be a private foundation and not a public charity. Types of private foundations, again, you can do it as a corporation or as a trust. So we're going to talk about the differences here. So if you set it up as a corporation, and usually I think this is how most private foundations are set up, but the structure really, it's operating as a nonprofit corporation that has a board of directors. It does provide more flexibility in how the entity is governed. It's easier to adapt and change leaderships because you just amend the bylaws. And it's ideal if multiple family members or stakeholders will have decision-making roles. Now, the disadvantage of having a private foundation that's set up as a corporation would be it requires more administrative oversight and formalities, such as you have to have regular board meetings. You might have to file certain documentation with the Department of State here in Pennsylvania. You may have to get an EIN, do certain tax filings from an IRS standpoint. So sometimes it just may mean a little bit more paperwork. On the flip side of that, we have a private foundation that's created as a trust. And either way you do this, if you would set it up as a corporation or as a trust, typically you are going to have an attorney involved to walk you through all the different requirements, because either you're going to need bylaws if it's a corporation, or you're actually going to need the trust document if you're dealing with it being a private foundation governed through a trust instrument. Now, the way it works if it's a trust is it's created through a trust agreement with trustees managing the foundation according to the trust's terms. Advantages is typically simpler to establish and administer because there aren't as many hoops as far as, the bylaws and having the board meetings, all of that. It's clear and legally binding rules regarding the use and distribution of assets for the private foundation, and it's ideal for donors who want strong, predetermined control over how assets are used. Disadvantages of a private foundation set up as a trust is its lacks flexibility to amend the terms or governance without court approval. So that would be a disadvantage if you wanted it to be more flexible and adaptable. Now, the way you choose between a corporation or a trust for a private foundation, you're going to select a corporation if you want flexible management with the ability to change board members or modify the foundation's mission over time. Another reason would be if you have multiple family members or others who will be involved in the decision-making process, because everybody gets a vote and then the board just votes. If you set it up as a trust, benefit here, or the reason you would do that is you prefer strict control and legal safeguards to ensure that assets are used exactly as they're intended to be used. And you would use a trust if you want minimal ongoing administrative changes or involvement from other stakeholders. So again, it's more tighter knit if you would think of a trust in that way. Let's shift a little bit, and the other topic I wanted to make sure we covered today is whether or not you should consider a traditional IRA and converting it to a Roth IRA. And the reason why it's a good time to think about it is that, like we've talked about, we could see a change in our tax structure. So the current tax rates that we're enjoying right now are scheduled to sunset at the end of 2025. If they sunset, they will revert back to the pre-Trump tax rates, which means currently right now our highest tax rate is 37% for individuals. If it reverts back to previous rates, it will jump to 39.6% as the highest tax bracket. So the reason that this is an ideal time to think about it is because if you are going to consider converting, remember that any amount that you pull from a traditional IRA, you're going to pay tax on. So when you do a conversion, you would be converting usually a lump sum or a portion of your IRA to a Roth IRA. Whatever portion you're converting to a Roth, you do have to include it in your adjusted gross income for income tax purposes. So that's why it's something to think about while our rates are lower, assuming that it sunsets, which we have no idea what it's going to do. Right now it's scheduled to sunset. We'll keep an eye on and see. Maybe as spring kind of unfolds, we'll get a better idea of how likely that is. But let's talk about what is a Roth IRA conversion. So a Roth IRA conversion is where you're converting a traditional IRA to a Roth IRA, and it allows you to pay taxes on the account now, so that when you withdraw from the Roth IRA in the future, those withdrawals are tax-free. The concept of a traditional IRA is that you defer paying the tax until you retire, with the thought being that when you retire, you're at a lower income tax bracket. But that's not always the case for our retirees. So if you decide to convert it to a Roth IRA, you don't get a deduction for any contributions to a Roth IRA, but the benefit is when you withdraw from a Roth, it's tax-free, and the appreciation on assets in a Roth IRA grow tax-free. So the reason you want to consider is it's tax-free growth and withdrawals in retirement. The other reason to think about this is that there are no required distributions from a Roth IRA. So if it's a traditional IRA, when you turn 73, that's the current rule. If you turn 73, you have to start taking RMDs every year, which means that you're going to have a certain portion that you're going to pay income tax on. Now, those of you that have started taking your RMDs before, because maybe you reached age 70 and a half prior to the Trump tax change, then you've been taking RMDs and you will continue to do that. But the beauty of a Roth IRA is that there are no required distributions that have to come out every year. So in theory, you could let it sit in your Roth IRA, not have to take RMDs. It would continue to grow tax-free and it would go to your beneficiaries. And when they're pulling the funds out, it's also tax-free and all that growth is tax-free. So it gives you some tax planning options if you do decide to convert. So bottom line is it can reduce the tax burden for your heirs or beneficiaries in the future. How can charitable, I think, did he mean distractions? It says, how can charitable distractions help your conversion? I think he means deductions here. So how it benefits you and charities. So number one, you can offset taxes with a charitable deduction. So you can choose to fund a charitable remainder trust or charitable lead trust. And by doing that, you get a tax deduction. And if you do it in the same year that you convert a traditional to a Roth, then it gives you something to deduct and you can offset the tax that would be generated through the conversion. So an example with that would be convert $500,000 from a traditional IRA to a Roth, and you would fund a charitable remainder trust in that same year with appreciated assets and receive a deduction large enough to offset that conversion from the traditional to a Roth. So it's not that you're getting more of a tax deduction, it's just that you're tax neutral because yes, you generated income when you convert it from a traditional to a Roth, but then you got the deduction for funding a charitable remainder trust, so those canceled each other out and you don't have to pay further taxes. Number two, it allows you to leave a tax-free legacy. So a Roth IRA can pass your heirs tax-free, avoiding both income and estate taxes. Unfortunately, Roth IRAs are still subject to Pennsylvania inheritance tax, but it does avoid income and estate taxes. Combining Roth conversions with charitable requests does ensure your family and charities benefit without those tax implications. Like we talked about, no required minimum distributions with a Roth IRA. So traditional IRAs require starting at age 73, unless you've already started taking them, which can increase your taxable income, but Roth IRAs have no RMDs, allowing you to retain control over those retirement assets, allow them to continue to grow tax-free. Can also align philanthropy with financial planning. So charitable strategies such as qualified charitable distributions allow you to use IRA funds for donations while lowering your taxable income. So a lot of times you're doing it in conjunction with other planning, I think is the bottom line. When should you convert a traditional to a Roth IRA? First reason would be if you want to avoid a large tax bill from the conversion. By funding a charitable remainder trust or making another large charitable contribution, you can offset the taxable income from the conversion that you've done from a traditional to a Roth. Might be you already support charities. So if you already do that, combining a Roth conversion with charitable giving allows you to reduce taxes now and still achieve your charitable objectives. You might also have appreciated assets. So if you donate appreciated assets or stocks to a charitable lead trust, it provides you a charitable deduction and defers taxes on gains, helping to cover the Roth conversion. Another reason would be you have no immediate need for retirement income, meaning that you don't need to take those RMDs. You don't need to pull funds out. So a qualified charitable distribution lets you donate directly from your IRA, reducing taxable income in the conversion year. So meaning you could take your RMD, directly to the charity. You don't have to include that and convert a portion in that same year. When would you not want to convert a traditional to a Roth? It would be if you can't make a large enough charitable contribution. So without a significant charitable deduction from funding a charitable remainder trust or a large charitable donation, the tax on the conversion may be too high to justify. That's where you're going to work with your advisor, your accountant, your attorney, and actually run the numbers to see what tax am I going to pay. And those of you that might be receiving Social Security, you want to keep in mind too that it might affect the amount of your Social Security that is taxed as well. So again, it's several things that you want to think through before you would do a conversion. When would you not want to convert would be if you have short-term income needs. So if you require most of your IRA funds for living expenses, then a conversion might not be beneficial even with charitable giving strategies. Another reason you wouldn't want to convert is you don't have appreciated assets or other tax reducing tools. So typically the effectiveness of the charitable deduction relies on having other assets to contribute because it allows you to offset the tax. And lastly, if you're not in a position to benefit from a charitable strategy, if you don't have any long-term charitable goals, you don't have a structured estate plan, other methods may be better or more effective in managing your tax liability. Okay, so our office, you can always call our office at 717-655-2676 to schedule a consultation to talk about charitable planning. It's always fun for me to get to talk about the different charitable strategies. We always encourage clients too that if they have a financial advisor or an accountant or a tax preparer that they really value their opinion, to go ahead and bring them or maybe have them available for the appointment, because I always think the best plan for our clients is when we have all of those trusted individuals as part of the plan. Okay, so I'm going to close us out and then I'd be happy to take questions. Thank you for joining us today talking about charitable giving strategies. This is Samantha with the Law Offices of Samantha Wolfe, and you can reach us at 717-655-2676 if you have any other further questions. Be sure to check out our YouTube channel where we're always posting videos that we're doing, and you can join us next month for our virtual seminars.